So I just wanted to run through that today. So NAB released a report a couple of weeks ago, and it was picked up in the press and reported probably a little bit inaccurately as far as I'm concerned. There's a number of geographical areas where they have capped the LVR. So basically, they've restricted LVRs to 70% and 80% in certain areas. They've referred to them as Group A and Group B. We'll have a look at the Group A geographical areas, or the restricted postcodes there. So that they've been restricted to 70%. So your LVR, so you'll need at least a 30% deposit plus cost to be able to get a proof of finance through NAB to be able to purchase a property in these areas. So look, it's a pretty good indication that there is some elevated risk there, but the reasons why we'll go into in a minute. Some of the postcodes, they're primarily regional towns. Regional postcodes in WA and Queensland make up the majority of the list. A couple of in South Australia and Northern Territory, and a handful in Tasmania as well. Like I said, they are mainly the regional areas. Gladstone in Queensland, for example, typically, mining towns or one industry towns where they've decided to cap LVRs to 70%. Now, if we go over to the Group B restricted postcodes, where the LVRs are restricted to 80%, meaning you'll need at least a 20% deposit to get finance from NAB for properties in this postcode, or these postcodes. There are quite a lot, there's 40 odd. A number in New South Wales, particularly in southwest Sydney, typically just going through a list here, your Cabramatta's, your Parramatta, Harris Park, those sorts of areas. Victoria is only got a few, but they're very interesting few. We've got Melbourne CBD, St Kilda Road, South Bank, Docklands and Abbotsford. Now, they're typically areas where there is a large number of apartment complexes, particularly going up now or in the recent couple of years, or underway now, which is very interesting. Sydney CBD was another one in New South Wales. In South Australia, we've got the Adelaide CBD, WA Perth CBD, and Queensland Brisbane CBD. So that does, I think, tell you something about if you're looking to invest in the capital cities. That should be a little bit of a warning sign to you that one of our major lenders thinks there's some additional risk in those areas. Now, having a look, particularly in Victoria, those other, as I said, those other areas, again, mainly full of apartment complexes. And there's a lot of talk recently around off-the-plan purchases and apartment complexes, and whether or not there's some additional risk there. Now, what's been reported on the back of this policy guidance from NAB is I've seen a number of commentators saying that there's a higher risk of default in these areas, so that's why NAB has capped the LVR. Potentially, yes, that could be the case in some of those postcodes that we mentioned in New South Wales. That's potentially the case, and historic performance in terms of defaults and people not being able to make their loan repayments certainly does come into play. It does, however, indicate a little bit of a not so great understanding, not great English there, a little bit of a limited knowledge of credit risk and what credit risk actually is. So credit risk is really the risk of the lender losing losing some of the principal that they've lent out to a borrower. Now, that's not necessarily someone defaulting on a loan, because the loans are going to be insured. There's a high likelihood that a lender is going to recover their funds, even if a borrower does default. In terms of losing your principal, the biggest risk to the lender is around the value of the security property. So obviously all home loans are secured by mortgage over a security property, and the value of that property is really key in determining how much a lender is willing to risk, obviously. and how much they're going to lend against that security property. So it really is more an indication that NAB, and I dare say this has been driven by the mortgage insurers as well. I've had a look at a number of these areas. They may have overexposure in particular streets or complexes or postcodes, obviously, and they've decided to restrict the amount of lending that they want to do in that area going forward. So they've reduced the LVRs to reduce their risk, so they reducing the risk of losing some of that principal if in fact there is a problem with a borrower making those repayments, so defaulting on that loan. And that could be an investor, it could also be owner-occupied properties as well. So it is still a good indication in terms of just something to be wary of. For two reasons, I guess. If you want to invest in those areas or buy in those areas, if you're going to NAB, you're only going to be able to borrow 70% or 80% LVR. So that's one issue that you've got straight away. If potentially you were looking to borrow more than that, up to your 85, 90, 95%, you're not going to be able to do that with NAB. The other indication, obviously, NAB's got a great amount of data, more than you or I, and they would, if they think there is some risk in those suburbs, and it's probably a little bit of a warning sign that you need to be just make sure you do your due diligence, cross the T's, dot the I's before you do invest or purchase in those areas. Okay, thanks for joining. If there's any questions, please feel free to shoot them in. The other thing I wanted to touch on as well is that if there is anything that you are concerned about, it really is imperative to do your research, particularly around the valuation when you're purchasing a property. We do offer our free CMAs in partnership with RP Data. They are a really comprehensive report. Hi Andy, thanks for joining. They really are a very comprehensive report. Now, it's what the real estate agents use when they're giving you a market appraisal. It does contain, morning, not sure where you are, Andy. It's late at night here, but good morning to you. Thanks for the hearts. So these reports obviously contain recent sales history. G'day, Matthew. Thanks for joining. The CMA reports from RP Data do contain, NC, nice. They do contain the sales history for that property that you're looking at. Also recent sales in the area. Now, this is really crucial because this is what a lot of people don't understand is that valuations really, it's not an exact science, and valuations, from a valuer, a professional licensed valuer, or your lender, for example, are based on comparative sales. Okay, so that's recent comparative sales, whether that's in your street, the suburb, whatever the case may be, in the recent past with similar characteristics. So, a 3-bedroom house will be compared to the sale of another 3-bedroom house. A 2-bedroom apartment will be compared to another 2-bedroom apartment. They'll take into consideration other factors as well, obviously bathrooms, garages, car parks, living space, so square meterage of the actual property, square meterage of the land size as well, a whole host of other variables, but to make that comparison. So the recent comparative sales is really the crucial factor. Now, those CMA reports will have all the recent sales data on there as well, and as I said, it's used by the valuers, used by real estate agents, and also relied upon by lenders too. It does have a rental market appraisal as well, to see what else is, what a property could potentially rent out for, what other properties are on the market at this point in time as well, so you can do a comparison there. Lots of demographic data as well in terms of the suburb, so looking at things like median prices, median price change, having a look at demographics of the area, household formations, so singles, couples with kids, those sorts of things, whether or not most people in the area are owner-occupiers, or they're paying off a mortgage, or they've paid off a mortgage, or potentially they're renters as well. So it really is a very, very comprehensive report. We offer that free of charge to all our clients as well. All you have to do, just jump on the website, pop in the details of your property, and we'll shoot that out to you. So it really is an invaluable resource. It does also give you an appraisal, a market appraisal in terms of the value of the property. So obviously data driven, all data driven, but that is what a real estate agent will rely on. So it'll give you a range, for example, 450,000 to 480,000. So it does give you that range to give you an indication of what the property could be marketed for. It is not a bank valuation that can be relied upon, so it's not going to give you a specific figure that you can then take to your bank and go, oh, I want to use this valuation to borrow against. You will still need to get a bank valuation if it is your own property and you're looking to refinance or something like that. We can absolutely do that for you as well. That's not a problem either. But if you are looking to purchase, whether or not it's an owner-occupied home or for an investment, it really is an invaluable tool. So you really want to have as much information at your disposal as possible when you're negotiating on a property. It really is crucial. So to be forewarned and forearmed and have that information at hand is really going to give you the confidence to make an offer, be happy with your offer, and understand the real intrinsic value of that property.